Welcome to the Deep Dive. We're here to cut through the noise, take that stack of sources you have, and really pull out the key insights. Basically, give you a shortcut to being well-informed. Today, we're navigating quite a whirlwind in recent market dynamics.
Yeah, definitely a lot going on.
We're talking Federal Reserve signals, some truly surprising corporate shifts, and, what might be next on the horizon. Our deep dive is drawing from market dynamics, Powell, earnings, and corporate shifts, plus key reports from Barron's and MarketWatch. And our mission for you today: understand what moved the needle, why it mattered, and really what you should be keeping an eye on. Okay, let's dive in. So we've definitely seen markets showing a mixed tone lately, and a big part of that seems to be coming straight from the Federal Reserve.
Right, the Fed's always central.
Fed Chair Jerome Powell dropped some signals. Our sources are calling them dovish. Now, we know you follow this stuff, but what exactly were the undertones markets picked up? And how fast did that change the math for a potential September rate cut?
It's really fascinating how hypersensitive the market is. Powell's tone, even without a solid commitment, was immediately seen as a significant softening. Investors heard more than just a possibility of rate cuts. They heard a stronger probability.
Okay.
We saw that market-implied probability for September jump, like dramatically.
Yeah.
Went from 75% just last week up to 85% this week.
Wow, 75 to 85.
Yeah, that's not minor. It signals a really rapid rethink by investors, all based on, subtle language shifts.
Yeah.
Suggests the market's pretty convinced easier money's coming.
And the immediate impact of that conviction, we saw, a mixed session.
Right.
The Dow dropped 349 points. That's a 0.8% slip. NASDAQ fell 0.2%. S&P 500 down 0.4%. But here's the interesting part. Even with that rate cut optimism bubbling up, futures for all three major indexes actually softened Sunday night.
Yeah.
What's that telling us about the mood? Are they buying the rate cut story, or is something else holding them back?
It's a classic case of the market saying two things at once, isn't it?
Seems like it.
I mean, sure, there's excitement about easier monetary policy, cheaper borrowing, potential economic boost, all that. But the market isn't just blindly rallying. Futures for the Dow, S&P, NASDAQ, each dipped about 0.1% Sunday night.
Okay.
So that suggests this blend of optimism and caution, like a wait-and-see vibe underneath. Maybe investors are remembering past bumps, thinking once bitten, twice shy.
Yeah, makes sense.
They're digesting the dovish talk, but also weighing it against, the actual economic data coming in, other potential headwinds. It highlights this nuanced view where, lower rates are good, but there's still this deep-seated vigilance, not quite ready to go all in on risk.
Right.
And for you, the listener, it really raises that question. How do you balance these conflicting signals, the hope for cuts versus this lingering caution, especially when thinking about your own financial outlook?
That balance, that tension between hope and hesitation is so crucial. It really shows that while the Fed sets the big macroeconomic rhythm, the market itself is this complex beast reacting to tons of other things.
Absolutely.
And our sources are just packed with those specific corporate stories that really shook things up, sometimes with ripples going way beyond just one company. This is where we get into some fascinating details behind the big stock movers. A totally different view of market dynamics.
Exactly. And these corporate actions, they're not just isolated blips. They're actually shifting whole sector dynamics, investor views, sometimes in really surprising ways. We can sort of categorize them to get a handle on the different forces. This is where the deep dive gets interesting.
Okay, lead the way.
Let's start with tech and AI. Still a massive gravitational pull in the market, right?
Undeniably.
Nvidia, a real bellwether for AI, meaning its performance is kind of seen as a key sign for the whole sector's health. It edged up 1%. Now, that might seem small, but it's significant because it's staying in focus right before its huge earnings report. Everyone's watching that one.
Everyone.
Then you have Apple, another giant,
Yeah.
climbed slightly. And this was even with the new AI lawsuit involving Elon Musk's companies popping up. Just shows how central AI is becoming, sparking these high-stakes legal fights.
Right, AI is everywhere now.
Now, Intel. Intel presented a really interesting, almost contradictory picture in our sources.
Oh yeah, how so?
Well, one report highlighted a 2% gain thanks to a big U.S. government investment. Signals confidence, capital injection, good stuff. But another source noted if stock actually fell. Why?
Yeah.
Because that same $8.9 billion investment gave the U.S. government a 9.9% stake.
Okay. So strings attached.
Exactly. It's not just the money. While government backing can signal strategic importance, a big stake like that can make investors worry about future government influence, maybe profit caps, or even, perceived nationalization risks down the line.
Right, that tension between stability and shareholder control.
Precisely. Shows how differently the market can read government involvement depending on the details. And then in e-commerce, PDD, a major player, surged nearly 6% after strong earnings. Just shows solid financials can still cut through the noise.
That Intel example really hits home how complex these things are, rarely just black and white. Okay, moving on to acquisitions and splits. These often trigger really immediate dramatic reactions, don't they? Highlights how strategy can be a double-edged sword.
Oh, absolutely. These can be seismic.
Yeah.
Take Keurig, Dr. Pepper, KDP, it plunged. Big time. Reports mentioned anywhere from an 8% to 12% drop.
Wow, why?
It followed their massive $18 billion deal announcement to buy JDE Peets and a plan to split into two separate companies. The market reaction screams investors weren't thrilled. Maybe the price tag seemed too high, concerns about the debt load. Or maybe the strategic logic of the split wasn't clear or seemed too complex, at least initially.
Yeah, $18 billion is a lot to swallow. Debt concerns make sense.
For sure. When companies take on that much debt, especially for a huge acquisition, the market looks very closely at dilution, execution risk, everything. But then on the flip side, you had Vital Energy. It jumped like a remarkable 14.5%,
Okay.
boosted by a $3.1 billion all-stock acquisition announcement from Crescent Energy. Now here's the classic twist.
Let me guess. Crescent Energy went down.
You got it. Crescent, the acquirer, saw its stock fall 4%. This shows that common pattern. The company being bought often gets a nice boost bought at a premium, but the acquiring company often dips, at least initially. Investors weigh the cost, the potential stock dilution, the strategic fit, the integration risks. Is that risk-reward math playing out instantly?
Yeah, that makes sense. The acquirer pays the price, literally and figuratively, right away. Okay, and then we have sector-specific headwinds and tailwinds. Reminds us that even great company strategy can get hit by broader industry stuff or geopolitics.
Absolutely crucial factors. Furniture stocks like RH and Wayfair, for instance, both declined. And this was a direct, tangible reaction to renewed tariff threats.
Yeah, the tariff talk again.
Yeah. For sectors relying heavily on imports, tariffs are a direct hit to costs, to millions, explains the immediate investor worry. But then gold stock DRD Gold actually rose, reflects gold's classic role as a safe haven when things feel uncertain or tense geopolitically. It's where money often flows when the broader market feels shaky.
Right, the flight to safety.
Then you look at crypto-linked names. iShares, Bitcoin Trust, Coinbase, MicroStrategy, all dipped around 4.2% to 4.3%. This was tied to broader weakness in digital assets. Shows how linked that whole ecosystem is. Bitcoin struggles, so do the related companies.
Makes sense.
And finally, American Eagle Outfitters, the retailer, slipped 2.7% after a downgrade from BofA. Analyst ratings, especially from big names like Bank of America, carry real weight. A downgrade can signal to big institutional investors that prospects have dimmed, potentially triggering selling.
So it's really a complex picture, isn't it? We're seeing everything. Nuanced government investments, huge acquisitions causing opposite reactions, tariff threats, analyst downgrades, all creating these ripples.
Exactly.
It just underscores how many different, often connected factors are pushing and pulling on any given day. It's way more than just the Fed. But of course, the big question is always, what's next? What should we be looking out for?
That's the million-dollar question. What's the next real trigger for a big market move? Looking ahead, markets are definitely turning their attention to several key data points, things that will give more clarity both on the corporate side and the macro side. Nvidia's earnings, like we said, remain absolutely critical for tech and AI. Its influence is so huge, its market cap so big, that a strong or weak report can really set the tone for the whole sector, kind of a barometer for the AI boom itself.
It's still the one to watch.
And beyond Nvidia, we're keeping a close eye on other key players. Dell for insights into corporate IT spending, Snowflake and CrowdStrike as measures of cloud computing and cybersecurity growth. Best Buy's report will give us a pulse on consumer electronics demand. That's a key indicator for consumer health going into the back half of the year. These individual reports together paint a bigger picture of where specific industries and parts of the economy are heading.
And it's not just the company news, is it? We're also talking broader economic signals.
Precisely. The market's also keenly waiting for those broader signals. That means important inflation data, huge influence on future Fed decisions, jobs data, vital pulse on the labor market, consumer spending power.
The big macro numbers.
These macro reports are often the biggest catalysts for shifts. And we also saw New home sales, for example. It declined modestly, but actually exceeded expectations.
Ah, interesting nuance.
Yeah, that detail, exceeding expectations even with the decline, tells its own story. Maybe about underlying resilience in some areas. So all these things are potential catalysts for trading early this week and beyond. They'll dictate where the money flows next.
What a truly fascinating deep dive. We've covered so much ground, from how the Fed's subtle hints shape rate cut odds, to how diverse corporate actions, government investments, big deals, analyst calls create these massive swings, and of course the critical role of upcoming economic data.
Indeed. We went from Powell's carefully parsed dovish hints impacting those odds to the drama of acquisitions where the buyer and seller react so differently, and those sector pressures like tariffs or crypto weakness. It really is a complex, interconnected system, macro and micro constantly influencing each other, and investor sentiment, like with those futures, can just turn on a dime. Never a single story in the market.
So before we wrap up, let's leave you with a final thought. Given this incredible mix of conflicting signals, you've got the optimistic rate cut probabilities, but then the cautious futures, individual stocks surging while the broader market dips. How do you weigh that short-term noise against the longer-term trends shaping the economy? What specific data point or maybe company earnings report will you be watching most closely this week to help connect those dots? And what stands out to you as the biggest, perhaps most surprising, takeaway from our deep dive today? Thanks for joining us for this deep dive. Until next time, keep digging, keep learning, and stay informed.